Today we're going to go over the different types of loans that are out there for purchasing a house and how to qualify for them. Stay tuned. What's up everyone, Andrew here with the Lake team in Houston, Texas. Welcome back to our channel. We have another great video lined up for you guys today. If you're watching this on YouTube, go ahead and smash that subscribe button down below if you haven't already. And we try to produce the best real estate content to you guys each and every single week. So with that being said, let's jump into today's topic, which is the different types of loans that are out there for home buyers and how you can qualify for them. So let's go over the very first one that I want to talk about is FHA. So an FHA loan is a government-backed insured loan through the Federal Housing Administration. And FHA loans are actually pretty common here in the Houston area. So let's go over real quick on what the qualifications look like. If you can't qualify for conventional financing, usually people come to FHA loans. So FHA loans typically have a little bit they're a little less strict on their guidelines when it comes to your credit scores and your down payments and etc. For first-time home buyers and for seasoned home buyers. But let's go over the credit scores. So unlike conventional, which requires 620, FHA only requires 580. Your credit score needs to be about 580. And if you're below that, there may be some exceptions, and those exceptions are going to be all with your lender, and they may be able to tell you what you could qualify, what you couldn't qualify for. Another thing about FHA, let's talk about down payments. So your down payment only has to be 3.5% of the purchase price. And the cool thing about it as well is if you don't have that 3.5%, a family member or a friend can also gift you those funds as long as those funds are traceable in a bank account. So we're going to go over debt to income ratios when it comes to FHA. And FHA, the guideline is about 43% debt to income. So what that means is you're going to take your yearly income, right? Divide that by 12, that gives you your monthly. And then from there, you're going to take 43% of that, of your monthly income. And then once you have that number, you're going to go ahead and subtract all of your debts. So if you have a $400 car payment, if you have a $200 credit card payment, all those different payments you need to add up, and then you're going to subtract from that number, and that's going to give you how much you can qualify for. But for conversation's sake, it's a 43% debt to income ratio. Some lenders may be able to go higher as maybe 50, 55%, 57%, and that's all depending on the lender and their comfortability with you as the borrower. So that's a better question, or if you want a better sense of direction when it comes to if you can push the higher DTI, then that's when you need to start talking with the lender, because this is out of my expertise. So what type of properties can you purchase with an FHA loan? FHA loans, you have to be the owner occupant of the property. You can't buy a secondary home, you can't buy a vacation home, an investment property. It has to be you, the borrower, occupying that property. All right, so that wraps it up for FHA. That's going to bring us to our next loan, which is conventional. If you can get conventional financing, that's typically the best route to go. Then that may change depending on your circumstances, of course, but your lender will be able to tell you more. But in my opinion, if you can finance or if you can get with conventional, that's the route to go. I believe if you're a first-time home buyer, then your down payment is only about 3%. If you're not a first-time home buyer, then your down payment's probably good. I think it's as low as you can go is 5%. So the minimum credit score for a conventional loan is 620. If you're below 620, you're not going to be able to qualify. Then you'd probably go the FHA route. But if you're 620 and above and you can qualify for conventional, I would highly suggest you go for it. Depending on what your lender says, there may be a better option for you or a cheaper route. But in my opinion, I think just for this video's sake, conventional financing is definitely the way to go if you have a 620 or above. So going back to DTI, your debt to income ratio with conventional loans, they start at 45% and go as high as 50%, and maybe a lender or two can go above that depending on their comfortability or what their underwriting systems can approve. But for conversation's sake, again, we're going to go with 45% debt to income ratio, that is DTI, and that's what you want to base your numbers off of anyways. Going higher than that may stretch yourself to the limits, but again, 45% is the number that you need to think about. So what type of property qualifies conventional? Basically anything. anything that's habitable can qualify for conventional financing. You can do your secondary homes, your vacation homes, rental property, investment properties, whatever. As long as the house is deemed habitable, you can qualify, or any property can qualify for conventional financing. Unlike FHA, you have to be the owner. You have to be the owner occupant, so you have to be living there as your primary residence. Conventional, you don't have to do that. All right, so the next loan that I want to talk about is one of my favorites that I've personally used before, is a VA loan. So in order to get your VA loan, or in order to be eligible for VA loan, you have to get your COE, which is your certificate of eligibility through the VA. Once you have that certificate of eligibility, then you provide that to your lender, and then you go ahead and get started on that process of applying for the VA loan. And from the VA, there really is no credit score requirements or limits, but most lenders will have their requirements as far as what they'll be able to fund. And I think most lenders really want to see around a 620 credit score to get qualified for a VA loan. So if you have anything less than that, maybe you need to talk to your lender to see if they'll get you approved. Some lenders may be lower than that, but again, for conversation's sake and for this video, we're going to go ahead and say 640 minimum credit score to qualify for a VA loan. So another thing, another big benefit to veterans when they use their VA loan is they don't have to put anything down. So 0% is how much you have to put down on the property to qualify. Again, it goes off DTI and all that kind of good stuff too, but 0% is a big benefit for veterans. So if you serve in the military and you haven't yet purchased a house through the VA or using your VA loan, I would highly suggest doing it. It does help out a lot. One thing to watch out for though, most people don't really know, a lot of veterans don't know, is that you actually have a VA funding fee. And I believe the funding fee is around 1.65% of the entire purchase price of the house, or its entire loan amount. So keep that in mind too. Your funding fee could be pretty high, but the good news is you don't have to come out of that out of pocket if you don't want to. That can be rolled into the loan. So let's say there's a funding fee of, I don't know, $6,000, right, or $3,000, whatever the case is. $300,000 loan, you'll roll that into these are just random numbers, right? So $300,000 loan, they'll roll that into, instead of $300,000, your loan will be $306 or $303 or whatever the case is. Or you could pay for it if you didn't want to roll that into the loan. However, whatever floats your boat. I personally just rolled it into my loan because I didn't want to pay out of pocket. I wanted to bring less as closing as I possibly could when I bought my house through the VA or using my VA loan. So just bear that in mind. You do have a VA funding fee. So when it comes to DTI for VA, most lenders want to see around a 41% DTI. So, I mean, from my understanding, there is no set requirement or set maximum DTI from the VA. This is all from the lender's perspective. This is all what the lender's policies and procedures are. So it's best to go ahead and talk with your lender, because you may be able to qualify, I don't know, 50, 55%, 57%, I don't know. So it really all depends on the lender that you work with. They'll be able to tell you more information about the DTIs when it comes to qualifying for a VA loan. So what happens if you can't qualify for any of those loans? You can't qualify for VA, you can't qualify for FHA, and you can't qualify conventional. There are options out there for you. It's just going to cost you. It's going to be a little bit more expensive. And what we call those is non-QM mortgages, non-qualified mortgages. So not every lender does non-QM, so you need to speak with some lender. You can do a quick Google search and find non-QM mortgages, or you could talk with the lender that you were trying to apply through and see if they do non-QMs. But so basically, non-qualified mortgage, there's a couple different products out there. You have bank statement loans, you have assets, collateral loans, right? You have crazy interest-only loans. I mean, we use those for investment properties to do fix and flips. But the most common one that I see is bank statement loans. So let's go over that real quick, what a bank statement loan is. A bank statement loan is it's exactly that. It's a bank statement. The lenders are gonna take maybe 1 to 2 months or 6 months, whatever the requirement is, of your bank statements to see how much money is flowing through your account, and they're gonna qualify you based off such, right? So another thing to kind of watch out for too is whenever you go the bank statement route, your interest rate's going to be higher, right? You're not going to be able to take advantage of low interest rates with the traditional financing, but your interest rate's going to be higher. Sometimes some lenders want 20 to 25, maybe 30% down because they see it as a risk, right? They don't know you. They think that since you can't qualify traditionally, they're going to take on that risk. And they want some skin in the game, essentially. So if you can come up with 20 to 30% down, and more power to you. And if you want to go the bank statement route, go for it. Again, I would talk to your lender and see what may be the best option for you. Maybe it's maybe it's as simple as just doing a few things on your credit report to get that squared away. Maybe it's as simple as just opening up a credit card to boost your score so you can qualify traditionally, or maybe it's not that simple. Unfortunately, maybe you're in a bad case, you still want to buy a house, you have the money to do it. You could definitely go that route as well for the bank statement loans, the non-QM route. There's tons of different products out there. So a quick Google search you'll be able to see tons of different lenders that are offering these products. All right, guys, that's pretty much going to wrap it up for today's video. Short and sweet, straight to the point. If you have any questions, comments, or concerns, feel free to reach out to me or leave it in the comment section below. If you have any further questions, you can visit us on our website, and all our information will be in there directly. Don't forget to hit that subscribe button down below as well, so you'll be the first to get notified whenever we release videos each and every week. We try our best to produce the best real estate content to you guys each and every single week. So with that being said, I'm going to sign off for now. I'm Andrew with the Lake Team here in Houston, Texas, and I'll see you guys next week.